We'll talk about it later. Hi, can you see me? But this is the first time we're trying this thing with Zoom. I hope you can see the Excel. I'm going to keep moving on as if you can see it. We have volume. I hope you can. I'm going to put this. I'm going to look at the thread also online. Okay, Zoom the Excel. Yes, I have to do this. Okay. We should have a much better volume right now. I don't know why this volume is so low. Okay. Hi, is this any better? I suppose it is. Just put this here. Okay. Apologies for the delay on this. It's taken about 5 minutes, but it was working yesterday, and I don't know why it's not working today. So I'm going to move this off. I don't need the audio. I hope they're much clearer now. Okay, there you go. All right, we can start now. We're just going to go through a couple of things over here. I am first going to show you the presentation we have. We're going to do this in two parts. First part is about, just a welcome to Capitalmind Live. We're going to do a little bit of a bond tutorial. A lot of you have mentioned about how you have been looking for bonds per se. You've been looking at how to buy bonds. Let's go quickly do a tutorial. The market's live right now, so we can actually see what's happening in bonds. So today the bond market's off. So in the sense, if you actually went to try and buy a mutual fund, you would not be able to buy it because the bond market is shut. I will show you otherwise how you could look at bond yields and so on. It's not so relevant right now. All we care about is very simple funda. If I were to buy a bond, can I get a much better return post-tax or whatever from a bond than buying a mutual fund online, for the period that I want it to be. Now, a lot of you will not be able to perhaps look at bonds in very detail because it's a lot of things that happen. But let me just start with how you look at bonds and what kind of bonds trade. So, for instance, there's a bond like IDFC First Bank, which was IDFC earlier before it became a bank. It issued a bunch of bonds in 2011 and 2010. So you can actually see this by going to SEBI website and then looking at the debt offer documents filed with SEBI or ROC, whichever. Search for IDFC here. Well, they call it Infrastructure Development Corporation. So if you go down all the way, you'll see that in 2010 and 2011, there were a bunch of bonds that were issued by L&T, Infrastructure Development, IDFC was one. There were a bunch of others, but mostly these two guys issued a lot of bonds. IDFC then became a bank. The bonds were transferred to the bank. So effectively, it's like a bank deposit, except it's unsecured. To be fair, fixed deposits are also unsecured, but they get a slightly higher priority in case of meltdown and they're rescued by the bank. But to RBI's credit, we have not seen a bank default on regular bonds. AT1 bonds are different. We'll come to that separately. But non-regular bonds, you haven't seen a bond, a company like a banking company, a scheduled banking company in India default. We have even Yes Bank's normal bonds have been protected, tier 2 bonds to a certain extent at least have been protected, and so on. So there is a reason to feel that this is reasonably safe, not phenomenally safe, but reasonably. Now, if you look at, now I know some of these, so we might actually be able to see them. I'll tell you how I figured out certain things, but before that, we have to see what this means. I was looking at this N6 bond. Okay, today this is 3010, which is today. I've just created this Excel which says what can you buy it at and what do you get at the end. So I'm just going to copy this format so that you can see it. It is 10,800 rupees you will get on 21st February 2021. So this is like a short term, 3 month, we are at 10, so nearly at November, December, January, and February. So about 4 months from now, you will make 10,800 rupees if you invest today. Now the question is, can I buy this bond? What do I buy this bond at? Now, the simple point is, if I buy it at 10,499, I'll make 9.47% annually for a period of 1 month. So if you see this formula, it's actually just a IRR between these two rates, but you can see the 300 rupees on 10,500 rupees, roughly a little bit less than 3% for 4 months. If you multiply that by 3, because you have to analyze it, 4 months annualized means you have to make it 12 months, which means multiply by 3. So if you're making 3% in 4 months, then you're making 9% in 12 months. So roughly that is the calculation, but you can actually do the exact calculation here based on the number of days, actual days between today and the maturity date. This allows you to say, okay, I don't want 10,499. Maybe I should bid 10,480. And you look at it and say 10.11. But how do you know what to bid? So let me, I've got an account, empty account actually, with just 10,000 rupees in it. So this account has no money. So let me see if I can expand. So I hope you guys can see this. Okay, I there is going to be an echo, unfortunately, because my mic is not working. But let's see how hopefully this continues to work. Um, okay. Um, so I'm going to also show you now how we look at these bonds. IDFC Infra Bond 1N6. The answer to looking at what you can buy it at today, it's not 10,499, it's 10,600 rupees. So this is the best offer, which means this is the best price at which you can buy right now. This is the best price at which you can sell right now. So this is actually for 10,494 is when you can sell, and 10,000. This is a very widespread, but in bonds, see, there's so many bonds. There's IDFC Bank, N6, N7, N8, a lot of things. It's the same bank, different bonds, slightly different interest rates. So you don't know what this bond is actually going to give you. So the liquidity in these bonds depends on what happens really, in the sense um, at the time that things happen, you don't know whether a certain bond will have liquidity or not. So today this bond may have liquidity, tomorrow something else. So you actually have to have a list of bonds. You can go to FinQs, which is created by Vikrant, who actually is VVB on Capitalmind Slack. So you can actually see the bonds that he's got. There's a bunch of bonds over here. All of these are different bonds. I'm talking about the inner details, so you can actually see the yield. So he's actually calculated the yields based on, for instance, Power Finance Corporation for PFC BS1 for a period of, I mean, of course, right now you can't see what the thing is, but the maturity date is 30th March 2021. PFC is Power Finance Corporation owned by the government. So you think that this might be reasonably safe. It's a AAA rated bond. And you have 8 bonds available at 5250. That means maximum you can invest in this bond is about 8 into 5250, about 40,000 rupees. So we could go and try to buy this. Okay, so the way I can do this is I can go to PFC BS2. I just create a symbol called PFC BS1 and say 5250. I want to buy 8 bonds. Or what if I bought at 5,200? Now the answer to what will I get at 31st March is actually in here. So we've got PFC BS2, 31,321, you'll actually get 11,099 rupees. Now, how did I know that? The answer is not easy to figure out, but let's look at this. Okay, there's an India bond info. In this India bond info, you can actually search for the specific ISIN of the bond. Now, what will I do? I'll go to bscindia.com. I am going to check PFC BS2 on the debt portion. So you have to actually change this PFC BS2 and so I look at the ISIN here. This is the ISIN, and I'm going to copy it and go to India bond info and debentures. I will actually see that this bond, well, if it actually comes out as. So this is a bond of under the long-term infrastructure bond series. This was a bond thing that happened in 2010, 2011, and and 2012, I think. So they gave you 10-year bonds. This is a date of maturity 31/3. So if they give it to you on the long-term infrastructure bond series, it will be somewhere here. So we could actually change this to Power Finance Corporation and see that Power Finance Corporation actually had a bunch of bonds. So if it was maturing March 2021, so it's roughly this one, it's probably what it is. So if I look at the tranche 1 prospectus, I'm going to download it. And when I download it and I show it to you, you will see what PFC BS1 and PFC BS2 mean. So over here, you can see over here that this was issued on 31st March 2021. There is a interest payment of 8.3% compounded annually, and the face value is 5,000. So if you say 8,305 annually for 5,000 rupees, 8.3% is roughly on PFC BS1. You can see here that you will get 5,415. Now, why do you get 5,415? This is equal to 5,000 rupees into 1.083. 8.3% is the yield. So that is exactly what you will get on 31st March 2021. So if you pay 5250 for it today, you will get 5415 on 31/3. These two and these two dates will translate to a yield of 7.71%. Now I like 7.71% because I am not going to get any place, including an IDFC short-term deposit, where I can get a pre-tax return of 7.71%, which is reasonably safe. What if I want more? If I bid on N6 10,600, which is what is available right now, I'll only get 6%. So I can see, one of them matures in February, one of them matures in March. One gives a yield of 6%, one gives a yield of 7.7%. So I might say, listen, let me choose the PFC BS1 bond. Remember also that this is a very liquid bond. So you almost always have to hold till maturity. Otherwise, you do not get you do not get this kind of yield. There's a difference and a caveat. We'll come to that specifically. Let me go here quickly and I'll show you how we can actually trade this bond. Now I can go to PFC BS2 and I can say BS1. It appears that somebody has actually taken off that bond, which is a problem when you have a live bond class, is that when the liquidity is less, somebody might actually take it off. So at 5415, is it even worth it? The answer is no, because if I went to the same thing and I put 5415 as a price, okay, where's that price? ID PFC minus 5415. This is like giving free money for 3 months. It's completely useless, right? So you find that PFC BS1 vanishes. It's not useful. You could do the same thing with a bunch of others. There is L&T Infra. In all probability, I may not be able to buy much here. So 2044.05, you've got a yield of 9.88%. Now this was there when I created this sheet about 10 minutes ago, but it's gone now. You get 9.88% for only 1 month. Now 9.88% is the whole year's yield, but you get this in 1 month. Now I've got a bunch of these we've discussed it about 11%, at 10%, and so on. But the same thing, if I went back into this and I said, listen, let's do 2047 instead, just 3 rupees of a differential, you will actually see this as a much lower value, 8.08. Again, 8.08 is not bad because there's nothing, remember that no liquid fund will give you 8% for a month. There is no chance of it. So if you have money for exactly a month, for instance, I may be paying, I want to park my rent, kids' school fees, which I will pay on the 2nd of December. Then I can look at L&T Infra and say, listen, is L&T Infra going bankrupt in the next 1 month? If it's not, I don't think it is, then I can park this money here. Maybe build up this, I sometimes do this over a period of time rather than all at once, where I park this money so that the money comes to me right around the time when I need it. So it's better yields than liquid, and you don't have to do much. And to be fair, if the money is required in the short term, I don't mind paying tax on an 8% yield, because what do I do? I have the money, I'm going to park it somewhere. No matter where I do it, I'll get taxed on this short-term interest. And maybe I can do it in arbitrage funds, but remember, arbitrage funds today give 4.4%. So post-tax, even that is what 4, even if you consider 4.4% post-tax versus 8% pre-tax, I'm fine. 8% pre-tax is good. Also, even if the taxation here could be complicated because I might get it as interest, which I'm fine with. I don't mind paying tax on the interest of 1 month because even if I paid 30% tax, I'd still get on 8% a post-tax return of 5.6, which is greater than anything else I can get. So, I mean, I don't do this on a regular basis with all the money I have, but I do it with I've started to move money out of liquid, especially this year, because liquids have started to give 3%, 3.5%. I mean, if the difference was like 0.5% or 1%, it doesn't make any difference. Now the difference is sometimes starting to be as much as 2.5%. So I've got 10% sometimes on the same bond. So I'm fine with this. Now, if we've got 9.88, we can actually go in and buy these bonds. The same thing can apply for a bunch of others. We've got Z, and we've talked about this on Capitalmind. We have an article on it as well. Let me just show you what this actually means. So if I went to the Z, I have to find the thing. So just give me a second. Here you go. So this is the Z, cash flow that the NCPS. Again, this is risky because you don't know what Subhash Chandra is going to do, but assuming that you were able to buy a bond, this Z NCPS, it's a non-convertible preference share. So it will get bought back by the company from now to March 2022. There will be different intermediate payments, 2 rupees 11 paisa, 1 rupee 12 paisa per bond. I mean, it's 3 rupees 64. So we're talking in paisa, but think of it as percentages instead. So you'll roughly, whatever you put in today, you'll get some part of it out by March 2021, then some part by April, some part by March 2022. This income is still taxable. So Animesh, Shradesh, and PV and Cat Pravina, they've actually worked a lot on this. So really thanks to them that this has come through. But the post-tax return, if Z doesn't default, is 19%, even if you consider that tax. So it's not too bad from that perspective. So how do you go and buy this? Well, if you buy this, what will happen? The answer is I can go to Zerodha and buy this particular bond at here you go. So I can buy it at 3 rupees 65 paisa. Now what happens at 365? I could make that modification. The differential maybe instead of 19%, it will become 18%. But that's still okay. If I trust Z, or I can put a small percentage of my portfolio into Z, so that it's a kicker, right? So if I have a 5 lakh rupee bond portfolio, I can say 10% of it. So 50,000 rupees goes into the Z bonds, where I think, unlikely that Z goes bust by March. So I'll get back 2 rupees 11 paisa by March. So out of 364, 211 is back. So my amount at risk has now become a little bit lesser. And then if I get the rest, it's a little bit more bonus. So, then I have to take the money that I got back and then redeploy it somewhere else. And that somewhere else could again be back in Z bonds, because they might still be the best thing out there. But we don't know in March whether people have woken up to the opportunity and said, no, let's not go to Z at all. Let's buy. Z is not going to default. So they've taken the price up to 6 rupees. At 6 rupees, the Z bonds return is probably only 8%. I don't know. I'm just guessing. But then you don't buy it. So you have to buy something else. So this reinvestment is dependent on what interest rates and what bonds are available at the time that you receive this money. Where will this money come? It will come to your bank account, not to Zerodha. So you have to actually see these entries in your bank account. And on a personal note, these things cause a lot of damage, because they send you money and they don't tell you what it is for, right? So when you get the money, you have to actually note down somewhere in some Excel sheet that on this date, I got this money for this bond. Reason is because your CA is going to come back to you, because Zerodha does not know that this bond matured. Zerodha's trade log is only going to show the buy. It doesn't know about the sell. The sell effectively was the maturity, right? So you will not see it in your Zerodha's P&L statement. You have to calculate this P&L separately, or tell your auditor that to calculate it separately, because this is a different thing. So now I have maintained this in a separate Excel sheet, so that when the bank entry comes, I mark it saying this date, this bank entry is this particular bond, so that when the CA asks me how much profit did you make on that trade, I can tell him. So bond profit matching is to be done, separately in a separate Excel sheet. You won't get it on Zerodha. So that is one caveat. But what if I took Z now and before the maturity date sold it off? Maybe the price will go up. What if other people have recognized the opportunity? Instead of me waiting for another year to get the redemption, I might just sell it. So go ahead and sell it. I'll tell you how that makes a difference. Here is a bunch of bonds that I had bought last year. This is IDFC Bank N1, and I bought, in many dates. Sometimes I got only one, and then I got two, then three, and so on. So I built up a portfolio, and let me just try and reduce this so that I can hide these. Okay, so this was N1 bought this year in July, because I was I wanted money for 3 months, and this is money that I'm keeping for some Diwali bonuses and all that. So it was like, okay, I'll get this money out by 12th of November, which is just about around Diwali, right? So you want to just keep it for all of that stuff. So it was just that I started buying these bonds, and N1 itself, I think I bought at that time about 12 bonds, different dates, different times. Okay, so we've got these numbers. So that's about 12 bonds. 12 bonds at 5,000 rupees is about roughly 60,000. How much did I pay for it? If I add this all up, I paid about 63,689. Now today, if I earn the maturity, I will get 5,400 per bond. And what is the bond I will get? What is the amount I will get back if I get 5,200? So I'll add a row over here at the end saying I'm actually going to sell this bond, effectively going to sell this bond on 12th of November. I will receive 5,400 per bond for 12 bonds. So 64,800 will come back. Remember, I invested some 63,000 or so on. And I just set up a pivot table on this entire table, right? So what happens over here is I've done this for the other bonds. I have N2, I have N3, I have N6. For N6 specifically, the maturity date is much further away. It's in 2021. So I'm going to say, listen, today's value of this bond is 10,600 rupees. Maybe I can sell it at 10,000. I can't actually, because if I look at the kite, I will actually see that the best buy for N6 is not 10,600, it's 10,494. Let me just show you what that means. Okay, I'll just say minus 10494 instead, just as an example of what I'll show you this thing is. I've created a pivot table with this. In this pivot table, I've said, listen, I want this bond to be IDFC First Bank N1. N1 is here we've got the dates at which we purchase them. They're all positive values, and the value that I will get on this is N2. Sorry, this is N2. So let me just change this to N1, and we'll see this. This is equivalent to a return of 9.62% on my 60,000 investment for a period of what, roughly from the beginning it was about 3 months, but not all of the installments have been 3 months. It was different times, different this thing. I got 9.62. Now the same thing, if I do IDFC First Bank N2, which is a different bond, I will actually see that I got 10.58 on roughly 2.5 lakhs. This is not bad, because parking 2.5 lakhs anywhere else wouldn't have given me something like 10.5. Arey le lo mere se 30% tax. Fir bhi I will get 7% post tax, which is higher than anything anybody else is offering. And I could do this on, now what happens to N6? I have this N6 as well. This is actually, even though I have got a lot lesser, let me just see if I got the numbers right. N6, I have 7. Yes. So I bought them relatively recently at 10,400. If I sold all of them right now at 10,494 also, I would have made 12% annualized based on what it is today. I can actually get out of that completely, or I can move this to 10,600 and say I'll wait till I get 10,600, which would be a 27% if it was today. But what if I got it next month? So I'll just say 2020, 11, 30. So just as an example, if I get that price by next month, I will still make 12%. So I could sell it in the market next month and make my 12%. Or I can wait till maturity and make whatever I have to make. And what will I get on maturity? I'll look at this. Okay, so if I were to look at 10, this will give me 10,800 by 2021. Effectively, I would have got 10,800 rupees by 2021, which is not this one, but okay, here you go. 21,321. Just think that's the number. So, well, this sounds a little less. No, I think IDFC First Bank N6 is slightly different. Let me just look at this. N6 is 10,821 to 21 to 21. And so if I waited till this thing, my return on each of the tranches I bought, slightly different because of the pricing and the dates I bought them. The yields were 9.75 to 10.1, which is okay. I'm okay with 9.75. So I don't mind waiting till then, but if I get great prices, like if I got a yield of 13% by December, then maybe I can walk out. So this is a way for you to kind of look at bonds and build yourself a bond sheet to buy. And it's very simple. You just have to go in and remember also that if you try bidding, you're not going to get anything. So somebody took off the 10,600 right now just as we spoke. But if you try this bidding thing saying, okay, I'll put 10,494.05. I'll put one order at 10,494.06 or even 0.1. This is not going to work in bonds. Okay, they're liquid. Nobody gives a damn about your 5 paisa increment. You want to come and buy it at this price or ignore the bond entirely. There are some 400 bonds in the market. Move on, find something else. That's the thing that I say. And or come back another day and find this bond and look at it. If it's there for the taking. You can otherwise build an algo to kind of track it. This is 10,750. You want 10,750, take it. Don't put an order at 10,740 and wait. Well, it's not going to work out. You have to either buy it or not buy it. It's just a very binary decision. And if you're a full-time person in the markets, you can track this. If you're a person who can write an algo to track this, you can actually write an algo. Remember also prices change every day. So what is 10,750 today as a yield? The same yield will be 10,755 rupees 2 days from now. So the price will increase for the same yield. So your bids can actually be higher 2 days down the line. So as you get closer and closer to maturity, also remember transaction cost matters. Zerodha cost me 0 from brokerage, but it does cost me 15 rupees or something like that when you debit when the actual sell happens, right? So if I buy one bond and I'm making, if I bought this 10,600 rupees as one particular bond, just one, and I would have got 10,800 rupees. So I'd have made 200 rupees on that bond, but I'll pay 15 rupees as transaction fees for this transaction when the debit happens. So I'm literally going to reduce my return, right? So I can't buy just one. I have to have plan to have at least 10, 20, 30 bonds. So it's a reasonably large amount. You have to be careful with this if you're doing some HDFC securities or ICICI and all that, because their charges just kill everything. Okay, we're done with that. We will now stop. That was a half an hour thing. I hope these are good questions. This was good. I will now move on to an AMA. Now let me try one thing meanwhile, because my other thing doesn't seem to work. I'll try from my my earphones on. I hope the noise is a little bit better. Okay, so here we go. So, okay. I'm not sure if you guys can continue to hear me. It takes a little bit of time, but okay. This might still be better than the other one. Let me know if this is there. This applies to Nihit also. Nihit, can you just ping me separately if you can't hear me? But I'm going to now take questions on the AMA part. Please feel free to ask questions on the on the left-hand side. On the Slack channel. So it's a little bit lagged. Okay, so if you ask a question, I can see it after like maybe 20-30 seconds. But obviously this is interesting from a number of other perspectives. Okay. So yes, okay, it was better earlier, I think, Nihit is saying. So I'm gonna remove this. Okay. Okay, we should be back on echo based microphones. Okay. Um, Here's where we will go through individual questions. I think we have one question on time weighted rate of return. TW. So the difference between the two is, of course, you have the cash flows. It's like SIP returns versus CAGR return, right? So which one should you choose, or should fund managers be responsible for controlling cash flows into their funds? I think there are two questions over here. Let me take this thing. Fund managers are not fund managers in isolation. They are fund managers that meet certain objectives for their customers. Um, some of their customers are institutional. These customers are smart, understandably brilliant, and therefore those investors say, "Listen, you are a guy. I will invest some money in you. I will take the calls when that money should come to you, and maybe I'll give you more money at sometimes and less money at sometimes. You will have a CAGR that say you are going to give me 15% a year, but I know that some days, sometime your return will be minus 10%, sometimes your return will be plus 25%. So it's my call to say when I should take out money when it's plus 25, I feel it's too much. It's my call to say when you're minus 25 and I trust you, so I will give you more money. So I will keep that call on my own. This is an audience that none of us caters to from a PMS perspective or from a mutual fund perspective. Almost zero. We do not really cater to these people as fund managers. Very few of our customers are like that. And those people will have family offices. Um, and those family offices will take care of a lot of these questions. Sometimes the family offices themselves have no idea about asset allocation, about things. So they depend on the fund managers to give those inputs. So I believe we are no longer living in a world where the fund manager is isolated from asset allocation or timing decisions of his customers. The customers themselves require those timing and asset allocation decisions to be made by them. Which also means the fund manager is also responsible for saying the market is too high, I need to go into defensives or I need to go into cash. These cash calls need to be taken by the kind of fund managers we have today. It's an evolving field. Earlier, it was not like this. People would do only these things, which is why index funds really work, right? Because they don't ever take the responsibility for asset allocation or for anything. You're to decide what you have to buy. But an active fund manager today has to make that decision. If the decision of a timing and asset allocation are being made by a level higher than the fund manager, then why do you need to be a fund manager? Just go into passive, right? So today the fund manager actually provides some kind of useful input in terms of both asset allocation and timing, and therefore we should, as fund managers or potential fund managers, focus on what our customers really care about, which is their ability to. So for instance, if we tell them that SIP is great, that means we need to create a more smooth curve for them. This is useful from a behavioral aspect also, because people, you might see ups and downs of 10%. I don't want to see ups and downs of 30%. This is actually better for the investor because he gets more confidence in continuing to invest, and his cash flows may also be on a monthly basis. It may not be all at one. It's not like most of us do not have this massive amount of capital that we can deploy at any one time. The problem with institutions is they live in echo chambers many times. They like to behave as if look, we're a fund manager, we don't care the asset allocation. Because what happens is some of their investors who are richer will probably tell them that. This is not true for a mutual fund manager anymore. And there are no excuses anymore, right? So if mutual fund manager is basically a person who's saying, listen, give me your money, I'll figure out the best way to handle it in the largish kind of mandate that I have. I don't believe that a lot of investors have anything more than that. They say, you're going to make me money, right? And you're going to invest in large cap stocks. Whether that large cap stocks in India or abroad, whether you invest all the money now or six days later, whether you choose the right opportunities, put some money in cash, I don't care. Find the opportunities, do your thing. give me returns. That's what people look for now. So therefore, as a fund, you need to focus both on time weighted rate of return. And so yeah, the other point is like, it's like, give me money, I'll just deploy it in the stocks that I want to at different levels. Maybe I'll buy a stock at its highest level, and where I also continue to think that there is no more value in it. But you know what, you're giving me money, so I better buy it because I need to build the portfolio like that. So this is, I think, an outdated concept. We need to acknowledge cash flows, not control. You can't control cash flows anyway, but you need to acknowledge that cash flows will be dependent, and we need to give investors a good return based on cash flows that they might have. And the most common one is SIPs. So if you don't look at SIPs, you will actually have problems in the longer term. But in general, because it's easier to calculate, people just simply say, listen, I'm looking at the CAGR, which is how my NAV has moved over time, rather than, so if the NAV has moved well over time, that automatically should mean that an SIP will work well. But it doesn't always. I'll tell you why. What if you gave a fund some money and it went up 75% in the first month itself, and it stayed there for the next 12 months? This means the guy who invested 12 months ago got a 75% return. But anybody who invested from 11 months ago got 0% return. So you can't ignore that. Your CAGR will actually look good. That means, but you can't ignore the fact that you have a bumpy kind of equity curve that is not suitable for people who have cash flows that are intermittent. So I think people should take care of both, and more so people who are doing SIPs if you're getting retail cash flows. We have we have a thought of building a mutual fund. We have applied. We will take some time to pass through SEBI approvals, and right now we haven't even completed our application to SEBI because they have a certain set of requirements we have to meet, and we will meet those possibly in 2021 March or April, and hopefully at that time we'll be able to convince SEBI about our processes, our thoughts, and the fact that we can manage money. We're already doing it as a PMS. We have the internal technology and the data-based frameworks that are required. But obviously mutual funds are a lot more disclosures, a lot more regulatory work that will come in time. When I don't know how many quarters we are away, that's a SEBI thing, but I want it to happen surely. I think all of us are working to make it happen. So what do you momentum, long-term and chase portfolios? Is there a recommended percentage? It's not actually, there isn't single one. So think of momentum and long-term. These are more stock-based portfolios, long only. So we don't participate on the short side at all. So I would say, based on who you are, either choose a long-term large cap for a significant percentage of your portfolio, then choose a multi-cap for a small portion and a momentum for a small portion. If you are a person who says, listen, I'm okay executing on momentum once in a once in a month or once in a week, and the long-term large cap doesn't do anything for you, in the sense, not many transactions. You just have to keep buying whenever you have cash flow. And the long-term multi-cap will have transactions maybe once a quarter. So you're okay with doing this. So you base this based on ability to do it and the risk taking also, because a long-term multi-cap and momentum will be a little more choppy compared to long-term large cap. I'm just saying a little more, because in reality, we've seen drawdowns, deep drawdowns in all of them, with momentum being the best in terms of drawdown control. But having said that, it's different for everybody. Some people, I would say, don't even take the momentum and large cap, multi-cap, because they're not comfortable with the kind of churning and risk that these portfolios involve. For some people, I'd say don't do large cap at all, because they've probably got money outside which is more stable and they want only the aggressive portfolio. So you do only momentum or large cap or multi-cap or both. Chase is a very, very different concept. It's a daily trading concept which will require a lot of work, but the alpha is significant. So has been, at least. So, and it's a very behavioral thing, right? You'll have 8 choppy trades before you get one big move. That one big move, if you miss, you would literally have missed most of the meat of the strategy. So you literally have to take every single trade, holding your breath. It's like cover your nose and take it kind of thing, no matter what happens. If it chops you 2 times a day, it chops you 2 times a day. You have to take it. It's a different thing behaviorally, but the returns in the longer term obviously have to be better. And we've seen this, right? We've seen 2 trades in the last month give you like 1,000 points, and then things get taken away from you into very quickly. So as in not all of it. So you made 1,000 points, you may get 300 or 400 points taken away, but you're okay at giving those 300 or 400 points, because you'll get another 1,000 points in the next big move. And over time, this has, I've seen it. We've seen the strategy work in good and bad years, and either it gives you as good in terms of returns from the Nifty, or it gives you a much lower drawdown. So or it gives you a much higher alpha on top. So there are years in which your alpha is significant. So this, I think, is one thing. If you have any questions, of course, please use the Slack channel to give us any questions or feedback. Okay, so yes, I think I was in the wrong thread looking for the links. Okay, we haven't got any more questions there, but let me talk about rebalancing as well. Chase is different, so you don't rebalance Chase. You just play it as much as you want. It's a trading-ish portfolio. But momentum and long-term, let it naturally decide. If you were to do a 50-50 between the two, between momentum and long-term multi-cap, over time, whichever is better will have a higher amount in it. I would say let that be your decision factor on what to allocate more to anyways, because if one is 60%, one is 40%, that's okay. Let's let that money continue or add in that proportion. Don't rebalance it, because both are strategies. They're supposed to work independently. There are times in which momentum will work much better. There are times in which large cap long term will work much better. So if you do any internal calls on moving this around, you'll have to have a framework for deciding what is so not useful from that perspective. So, okay, one second. I'm just going to cut this out. Yes. So I don't think rebalances are a big deal. But you should rebalance within the portfolios according to how we say it. So for instance, if you're rebalancing multi-cap, then you take the money out of whichever stock is going out and add more to whatever is coming in. Sorry, I'm just going to drink some water. Okay. One of the questions is, can Chase be a Cat 3 AIF managed structure? It can technically. We meet the leverage requirement. Chase will then require 1 crore per person. We are testing this out in terms of volumes and size. We'll have some kind of data on it, and then we can look at what it means for creating an AIF. I mean, it'll be quite interesting to do that. The problem really is taxation, because if we beat the Nifty on a down year, you'll make most of your money on the short side. The short side is taxed at 42%. Current AIF rules. I think there's a structure where it may be only 35%, but let's see. I have to analyze that a little more. But anyways, what might happen is, you need a way to balance this out in some kind of a meaningful way. But this will actually be quite interesting as an AIF strategy. It will, of course, limit then us to only getting money from people who have 1 crore or more to give us. But this strategy has scale because it works on Nifty futures, and Nifty is probably one of the largest. I think it's the largest option market in the world now. Probably one of the largest futures markets as well, as Vashish told me I think yesterday itself. So I don't think volumes are going to be so much a problem, but it restricts us to only the top level. So not considering it right now, but we'll wait and see where that goes. Okay, how do you invest one time SIP or in a few parts, or if they're buy call? So I think what you do is, let's say you're doing a SIP, you just look at the portfolio that you have. They will be slightly different percentages. What way I would suggest is do equal weight in all of them. Just divide the money equally between all of them. We've kind of taken care to say let's not add stocks that are too expensive in it. I think the most expensive right now is Atul at 6,000 rupees. So if you have a 6,000 rupee stock, the minimum you can add on a portfolio level is 1 lakh. But even if you didn't, and you said, listen, I can't buy, I'm only going to put 50,000 this month, we will we will actually have a simplified mechanism. I mean, eventually we will have our own technology to handle this. But let's say you're disbalanced, it's okay. Even if you're disbalanced for a couple of months, what's the big deal? When you get more money, you just then only buy Atul. To give you an example, I can quickly show you how this works. I'm going to just quickly, maybe look at the Capitalmind long-term portfolio. I'm going to show this to you, online. Yeah, here you go. So let me just create a new sheet and try this, which is, so let's say this is our long-term portfolio, which it is. I mean, this is actually our long-term portfolio. Here we go, paste values only. And then we've got a price of this, right? So if I want to buy, okay, you can't see this because it's too small, so I'll make it 150%. Can you? I hope you can see this now. So here is where we are. So if you were to put, let's say, 200,000 in this portfolio, and I wanted in each of these stocks, I wanted 6.66%, right? So so I wanted the portfolio to have 6.66% in each. So I'm going to put this. This is intended value, in a way, intended. Okay. So yeah, earlier the idea was multi-cap was in 4 tranches, but now we're like saying go for the SIP. We changed that in the rule. Now it's like you can buy it in every month or how it is. Now it's 15 stocks only. So I will just say is equal to F4 by this. So I want to put 13,220 in each stock. Now, how many shares does that give me? I can't buy partial shares. So I'll say I want to truncate this as this divided by the price. So I'll buy 4 shares and so on. So what will I actually pay for it is this into this price. So I actually, if I add this up, I will actually pay less than 200,000. So I have some cash left over. Which is basically means that this portfolio is not exactly aligned. So if I look at this divided by this and make it a percentage, not all of them are 6.66%. Some of them are more, some of them are less. And this difference is even more apparent if I make it 100,000. You'll see that some are now 7%, some are 5%, and so on. If I make it 90,000, you might not even be able to buy Atul. So Atul becomes 0, alkyl amine becomes 8%. But that's okay. Let's assume that you put in 90,000 on the first month, okay? And then the second month, you brought in another 90,000. And the prices were exactly the same. It's like this right now, you've got a different set of shares. So now your portfolio will actually become this 90,000 plus the 73,000 that you already had plus the cash. Just to give you an example, so you actually have a cash deployable of 90,000 plus the cash that you earlier had, which is 1,06,000. Now I want to divide that into the same percentages. That means if I were to have that, what is the kind of shares that I will need? So what I'll say is So this is the number of shares I should have. This is 6.66% into the total portfolio F4, which is the amount of money I need to have on a per stock basis. So this is the new intended allocation. I already have this much. This is 5,952. So the new money should be, so to give you an idea, it means this minus what is already invested. And I put this again, and then I can divide this. So I can say is equal to truncate of this divided by the price. And I will buy, these are the incremental additional shares that I have to buy. Now, how much will that cost me? This into the price, and we have something. And if I add this all together, it will be 90,500. Again, it's not the full amount. I had 1,06,000. I bought only 90,000. So now I still have some cash remaining. So that cash is equal to this minus this. And my total portfolio now has how many shares? Is equal to this plus this. So this is the total number of shares I have portfolio after the purchase. So this is new shares. So you have now these many shares. So as you can see now on the second time when I brought another 90,000 rupees in, this was the incremental value. Suddenly I have now one share of Atul. I keep doing this over time, I'll get enough shares, because now what will happen is, even if I did this now into the price, so sorry for the confusion over here, but I'm going to just put, it's gone a little bit to the right. I have a portfolio worth 1,64,000. So what is my valuation? So plus I have some cash, I have some cash of 15,000. So if I add this together, what are my percentages now? So is equal to this divided by 4. And now you can see that some stocks have come closer to that percentage, 6.66%. So what was 8% as in the second tranche has fallen to 6.66. 4 has become 5, which has come closer. 0 has become 3.35. Better, but not quite. You do another tranche. Instead of 90,000, I'll add 150,000. Just to give you an example of what that means. Now suddenly everything comes even closer to the required percentage. So you can do this over time, keep adding. The prices also change. The new additions will get you closer and closer and closer to the required equal weighted allocation. When we start putting weights in, we'll tell you exactly what weight each stock should have, and then you can readjust accordingly as well. Cool. So here you go. Go back here. I think there are a couple of questions. I'll quickly answer those. One was about multi-cap momentum PMS versus CM premium. They will be different. Yeah, I don't expect to have the same kind of stocks. We've restricted premium to 15. We will have that because it is too difficult to have a 30 stock strategy explained all the time to people. So it's more easy to keep 15 stock to explain. So it's not, I personally believe that you can have 70 stocks and still make money. So we think in the PMS, we can manage it much better. So we have 30 stocks over there. We'll have 15 here. There will be some overlap, but not all. And it will remain that way. There are different reasons for keeping them separate. And CM premiums, long-term multi-cap will have a different portfolio. But what are the theories for selecting and deselecting stocks? So philosophy, we've kind of experimented a bunch of philosophies. One of them that we really like, settled with is, can we think of long-term growth here as one of the parameters for a stock? Now, unfortunately, this is not always true. We've had stocks which haven't grown, like maybe we've had in the past GNA and Jamna Auto, and they've degrown sometimes. So we've taken them out when they've done that. We get out of stocks because of corporate governance issues sometimes. We've done that with Divi's Lab recently in Aarti Industries because the promoters were selling. We got out of a few other stocks recently on the banking front because we thought the whole banking system is in trouble for the near term. We might come back to it. So the philosophies will slightly vary over time in terms of what we choose, what reason it is we choose to deselect or select. But we want stocks that we want to hold for the longest term. This does not mean we'll only hold and buy and hold forever, which means we will keep our winners. Look at Garware, it's been 4 years plus. We started buying it at 350. Now it's at 1,900 rupees, and we're still holding it. And we've seen this stock go through ups and downs, and we still don't believe it's a great time to just exit it completely. There are no governance issues according to us, so we continue to retain that stock. Manappuram we've retained for a long time. Some of the other stocks, HDFC Bank, which in general would be a great long-term story, we feel that the banking system is going to get impacted now, so we got out of it. We might get back in at some point. That's fine, but don't see the need of holding it. We're very concerned about, say, Lal Path Lab even now today. It was very richly valued. We're not getting out right now per se, though maybe we feel a little weird about it from the large cap, long-term multi-cap portfolio and premium. But given a point where we see an impact to it on the downside, we might get out of that as well. So okay, so yes, I'll come back to everything else. Please create a separate channel. Now with these long-term stocks, we can discuss. We post a lot of the results and analysis on the long-term stocks channel. It will contain any stocks which you like also, which we'll discuss over there, which could go into the long. Remember, long-term portfolio is not something you build overnight. You have to build confidence in a stock. And sometimes that confidence will come when this price is maybe sometimes 2x of what it was when it was first discussed. It's fine. You're investing for the long term. 2x is not going to make your life miserable. Everybody likes to buy at the bottom. I actually like to buy at the top, even long-term stocks, because sometimes it takes that much, time to build that confidence. And at a new high, the price is actually better for you, because that means it tells you that people like this stock, and also that the earnings is probably matched what thought processes were created in the beginning to say that it will. So it's a good time to add such stocks into portfolios. Remember, in multi-cap, we don't do things like, buy a little bit now, we'll add more later. It's almost like if it's there, it's getting a 6% allocation. So because of that, we as a fund manager, I take a timing allocation, a timing call, and I'll grow it over time kind of call. But as premium, where we're only advising, a portfolio position has to be a full portfolio position no matter what. I can't tell you, okay, buy only 1% right now. After a month, say, oh no, it didn't work out, sell it. This will look really like weird. So that's why the position entry and exit criteria are slightly more different for a person doing this. Sometimes you'll see that people would have bought stocks. We've been discussing it for a while, and then we added to the multi-cap portfolio. But because, simply because the discussion itself has prompted some people to make a decision themselves. But that's fine. Coming to another quick question. Okay. Regarding the utility of debt funds from 25, debt funds are not required. I think Sharninder is right. You don't allocate to debt if you don't need it. Debt is basically a stability thing, with the little bit of an exception that you could actually use it to create alpha or wealth for you if you're able to track interest rate cycles. But we've done that. We've done what, 10-12% on gilt funds last year. That's better than a lot of equity returns. So, in a way you could do that. But beyond that, I don't see, if you don't need debt, don't take it. If you're not a person who doesn't mind losing all this, it's very easy to lose wealth when you're 25, because A, you don't have much of it. And B, you have so much left to earn that sometimes your wealth is equal to half your annual monthly income. So the guy who's 25 who's earning 2 lakhs a month, a lot of people who are 25 are earning 2 lakhs a month nowadays, may have a surplus of 1 lakh rupees. Kya ho gaya if he loses 1 lakh? It's no big deal, man. He'll earn it back in like a month or so. It's not a big deal. The same guy, if he has 50 lakhs in savings, is making 2 lakhs a month, he's going to be a little more careful about his wealth. He'll need more debt. So it's a mentality thing. Are you willing to risk that kind of money? If you're not willing to risk that kind of money, you put it into safer avenues like debt. Gold is not safe. Debt some part of it is not safe. There are only some elements of debt that is safe. And we've talked about bonds, but within the bonds, I haven't gone into even India Bulls housing, which I mentioned yesterday, because it's just risky. Okay. And so most of you watching this will not appreciate that level of risk, because when I say not appreciate, I mean, you will not like it. It gives you sleepless nights. I don't mind buying risky bonds for 1% or 2% of my portfolio. It may not do much as 1% or 2% of the portfolio, bond portfolio, but I know that that will provide a little bit of a kicker. I could get a 20% return on that 1 or 2% of my portfolio. That gives me a little bit of kicker where the safe stuff is giving me 6. This adds it up and makes it 7 at a portfolio level. Even that is good enough for a bond person. But the mentality there should also be that, listen, if that 1% goes bust, it goes bust. It should not be like make me feel miserable at that time. Okay, so yeah, let me go to what is your take on a buy and hold strategy? Like I said, I don't think there's a concept of buy and hold in India that works forever for all stocks. You should always be ready to get rid of your stocks when you have a stock that leaves you for whatever reason. I don't think it's useful to sell for pure valuation reasons, but you should sell when you need the money. You want to buy something else. You want to generate cash. You want to rebalance your portfolio because some stock has become too big. You want to reduce your sectoral dependence, perhaps, like we did with banks. We didn't necessarily sell only the bad banks. We sold all the banks we had. So these are reasons why you will sell. Does value investing even work then in India? I mean, it works. Everything works at different times. There are people who've made a lot of money in value. There are people who made money in momentum. It's just different time frames. So sometimes the value guys may not make money at a portfolio level. So some of their stocks will make a lot of money in the times like this last 2 years. But the next 2 years, they might be the ones who make money on all of their stocks, whereas the momentum guys will make money on a few stocks, but not in some others. So there will be these periods and regimes. It's very difficult to figure out which regime is going to happen tomorrow. All I can say is you be true to yourself. What works for you, make it happen, because you can't subscribe to all of these philosophies and make all of them work. So you'll find that in the Capitalmind long-term multi-cap portfolio, a lot of momentum, because we're inherently momentum people. Okay, so we love momentum. So you won't find us buying. I mean, we used to do that, but over time we discovered that that doesn't make sense to buy relatively very low undervalued stocks. I made my mistakes. I continue to make those mistakes. I don't think Yes Bank is a great stock because of that. And I think Yes Bank, as a momentum player, you also have to be very cynical of that momentum, saying that half of these guys will be bullshit people that we just have to make money on, walk in and walk out. They're not great long-term stocks. I don't think Loras is a great long-term stock, to be honest. But maybe if the corporate governance issues don't flare up, maybe Dixon is. Maybe Root Mobile could be. Right now, we haven't bought it in any portfolio. It doesn't have too much of a history to go for buy for momentum, but it's doing a lot of very interesting things, and maybe that is what it is, and maybe that's what we should be buying. And we bought Naukri. I think it's a great long-term story and a great momentum story. So necessarily what you do today may not be true to what you will do tomorrow. But you should be true to a philosophy that you like and you accept. If you don't like momentum, don't trade the momentum portfolio at all. You like value, then do the value investing piece. But when it doesn't work, it doesn't mean it's not going to ever work in the future. It will work. But the problem is, I say this very often, sometimes you have to learn this over time, because sometimes the value people have a momentum streak in them. I went and met Dolly Khanna's husband, Rajiv Khanna, and I was probably the only guy over there who was even into momentum. Everybody hated that word there, but they, quietly over there, they asked, what do you like when you buy a stock? And I'm like, listen, everything else is great. Everybody talked about earnings, cash flow, ROE, this, that. And I was like, all that is fine. It needs to have a little price momentum also, because otherwise it's not going to make you money. And Rajiv Khanna looks at me and says, honestly, I also like price momentum, because I can hold a stock for 5 years and sala kuch nahi hota hai. And all the fundamentals have come and gone by that time. So you need that price momentum to work in your favor sometimes. So he's figured out that's who he is, and he still says I make my mistakes, but it's okay. I mean, I when the stock shows momentum, I will do my best to make sure that it gets the highest allocation. So that's partly what will work. So yeah, what's the best possible way to grow wealth via SIP? So we have a lot of money being printed everywhere. They want to make your stock prices go up. Biden or Trump, both have only one objective, that the stock market should go up. Nobody's going to say this explicitly other than Trump, okay, to give marks for his honesty. But it really means that these guys are working really hard to make sure your stock markets go up. So I think putting money into SIP, partly at least into equity, is a great idea. In India, it's okay to buy debt also because we have a reasonable return on debt right now. But the best way to make wealth is to set up your own business. You will make money, a lot of money that way, a lot more money than you can using stock market investments. And it's a lot better experience. If you get so much wealth, then that to manage that wealth, you can use stock markets. You can control risk by using debt markets. You can use derivatives, chase, and all that stuff. So if I were to tell you real advice, figure out a business you can set up and run. But beyond that, invest in businesses that other people run, which is why I SIP into stocks. So that's my theory, the thought process. Quick segue into other questions that are being asked. I think utility and okay. So what are the parameters? We've actually talked about that. We use a lot of parameters. I mean, the thing is, when you look at the fundamentals of a stock, you've got to look at whether it does its P ratios are give you enough room for moving up. Although I know it's a badly used thing. Coffee can means you can pay anything for it, but I don't think so. I don't like that philosophy per se. I also think that you should look for red flags more than you look for green flags. It's not so. Red flags means things that like promoter pledging too much here and there. So that just makes you uncomfortable. What makes you uncomfortable will not make you money. So in the long-term portfolio, in momentum, only what's uncomfortable only will make you money. So in a long-term portfolio, you've got to make sure that, over time you choose these things. It's okay to make mistakes. That's why buy 40, 50 stocks. It's okay. Some of them will be missing. You don't have the time to go through every balance sheet with a fine-tooth comb. So just go through, buy a little bit, and if the stock is continuing to do well, add more money to those stocks. That's my philosophy, at least over the longer term. So we've created a stock portfolio of 15 now because this philosophy is very difficult to tell other people. But over time, you will not just invest in multi-cap, you'll also buy stocks on your own. So it's okay to buy a punt portfolio, keep 5 lakhs or 5% of your money separately for that, and then slowly build on it. So wherever your punts start working, they can move into your long-term portfolio as well. Okay, so I'll come back to, there's no algo we have for bond scripts. I wish we did. If we did, we probably would put it in the PMS and not tell anybody about it. But right now we don't, and it's just a thought process. So my stocks, I don't have hold forever because I don't think we'll hold stocks forever. Every stock will have an end date sometime. So I don't want to say there are 5 stocks that I want to buy and hold forever. Today I'm buying X. And that's InfoEdge and Manappuram and Garware and Hero Motocorp and all of that stuff. But tomorrow, if things look bad, I will get out of any of these stocks without batting an eyelid. I don't care who these people are in these companies. I don't care if they are the most honest people and trustworthy people in the world. If I see signs that this is not that they're doing something wrong, or that I found a better stock, there are no loyalties in the stock market business. Walk away, take your losses first, and then regret in peace. So don't do that buy and hold forever thing. Now, here's one interesting question, because if you have a sector that's disproportionately affected, where you might not be clear right now, but would be over a period of time? I don't specifically know the answer to this. In since if I knew, I'd probably put all my money in there. But I think certain things have become more clear that India actually has survived quite well. Whatever we say from this crisis, we've had a beating, okay, in the markets. It's very clear now that the guys who are unorganized and who have been doing this shady stuff over a long time, and a lot of people have been. I mean, we and you and me know us know this, right? So you call a painter for painting your house, you will effectively tell him that यार GST नहीं देता हूँ, आप cash में देता हूँ पैसा. That is unorganized. We are also unorganized there. Right? It's not just that some random people on the street are unorganized. We are also part of this whole spectrum. This is getting clearer. Last 4 years, see demonetization, GST, COVID, it's killed the informal players slowly, one after the other. This is horrible for the economy because the economy was based on these people. But it also means a layer of formalization, which means a lot of formal, larger stocks. And even the informal players will become formal. Okay, it's not like they're stupid. They're seeing this and they're saying, okay, what's jo karna hai karte hain. They're getting more formal. In Bangalore, it's like you go to supermarkets a lot more often than you used to earlier. You used to go to markets, small, tiny little markets where you used to buy vegetables on the roadside. Now, today, you go to supermarkets where you go into an AC place and buy vegetables at 5x the price. You don't care, but you're buying it. And the more proliferation of this that happens, the more of the larger and formal kind of economy that will kind of build up. I think that is what we should really see. We've seen this in time. Movie theaters were places where you stood in line and hoped to get a ticket, or you paid black and got a ticket. PVR changed that, made it formal. Suddenly you've got tickets online. You can buy it from your home, land there, use your phone as a ticket swipe thing, and get in your seats and popcorn, and everything is 5x the price. But you're able to enjoy that experience in a very different way than you used to when you were yeah. I mean, I am the old guy. Okay, many of you probably haven't seen that phenomenon of independent theaters and stuff like that. But that changed right in front of our eyes, and we accepted it. What will happen going forward is this phenomenon will pass everything else that you are looking at as informal today. It's already happening. Painting is coming from online. You're able to book a pickup truck to move your goods online. All of this, it's not just online. It's the fact that it's happening at a formalized level rather than, do you know somebody who can come and fix my window, versus now calling somebody, and it's more formalized as an ecosystem. Things will change. And iron and steel, coal, all these things which are commodity driven that fill our indexes today will tomorrow be replaced by these new age technology service or product oriented companies over the next 10 years. So I think you should be very careful of watching companies like India Mart, who are facilitating this transition. Just Dial, perhaps, facilitating this transition. Naukri, which is investing into this phenomenon as well. They have investments in Zomato, Policy Bazaar, and so on. This is what I think will change over the next few years. Very boring answer, but because I can't use specific, अच्छा ये कंपनी खरीदो ये चलेगा वो नहीं चलेगा, that is not how I'm thinking about it. But I think this is the change we're seeing, and COVID facilitates it. What do you think of banks? Banks will give you numbers in January, and they will tell you really bad things in January. But I think we'll get to know by the end of November how much the damage is, because they will talk to analysts, and analysts will get the information out of them on how the NPAs have moved. But a lot of banks are now safer because they may they won't go bust, but they'll have periods of underperformance. Bajaj Finance, for instance, no growth last year. Kotak, deposits actually grew only 10%. Loans came down. So it's not like they're a great bank. They were growing at 40%. They may be growing at 40% on profits, but their loan growth has come down. So what they're getting as profits today is because of a lower cost base. That has happened in the last 6 months. Take 1 year from now, if you haven't grown your loan book, you're not going to grow. He's saying, I will grow. but he has to, because otherwise he can't justify his 4x book price. So I think banks will start showing true numbers, both in terms of NPAs, in terms of growth by January. And they might choose one of these quarters to give us really, really lousy numbers. But that will be when the markets are down a little bit. So they'll say ki market anyway down. Chalo. So I think that's where we are. Quick segue into questions. Where will markets be 3-6 months? I wish I knew. I don't think I know where markets will be 2 days from now. 3 to 6 months to dur ki baat, but I feel there should be a lot more volatility. We should see a 20%, 10-15% downturn, and perhaps a 15% upturn from there, 20% upturn from there as well. So the thing is, there's a lot of money. That money will come into stock markets, it will come into private markets as well. And the US elections don't really matter. No matter who comes, there will still be money on the table. But what you have to watch out for is fraud. Lot of fraud will get destroyed in the next 3 months, 6 months. And that fraud will come out because of a few changes from a regulatory perspective that are happening. So watch your companies carefully. Otherwise, I think longer term will do very well. The economy will do very well. You have to be an optimist, okay, if you want to be in the stock markets. So you have to think 5 years later, things will be much better. It hasn't worked out in the last 5 years. Stock markets have not been better in the last 5 years, but that still means the next 5 years could be significantly better. And if you don't have that optimism, buy RBI bonds. Really, I mean, I'm not being facetious, but if you're not optimistic about the future, this is not going to work. Stocks are going to be like lousy, return candidates. Yes. What are the cons of a CMMO strategy? And we're talking about this. Momentum suffers from the same benefits and drawbacks. Why can't it replace? Of course it can replace. It's about who you are, right? Risk management is built in there already, but you have to take that risk. You have to be willing to be 80% cash or 70% cash in March without knowing why. We were in cash in March 12th or 13th. Nobody knew why we were so much in cash, but the system told you that you had to take it. It seemed like boss stocks are down 20%. We haven't been 20% in so long, but they went down to fall 33 and decimated a lot of stocks. So yeah, I mean, I think it's a great replacement for a fundamental strategy if that is who you are. From a perspective of what makes people avoid it, it's because of higher churn, and then the fact that a few of your stocks will be winners. There'll be a lot of losers. That means out of about 100 stocks that you pick, there'll be 20 stocks that will give you all your returns. The rest will be return equals loss. So if I divided your stocks into quartiles or even quintiles, so if I divide it into 5 levels of returns, the top quintile will give you all your returns, and the remaining 4 quintiles, that is quintile 2, 3, will probably balance out what you lost in 4 and 5. This is not a philosophy everybody can digest behaviorally. People like us, I mean, a lot of you are very highly educated. You've never thought of your life as 4-7 सब्जेक्ट है ना, 4 में पास हो जाऊंगा, 2 में फेल हो जाऊंगा, and 1 में normal just about. So you won't think of, I'll get 95% in one subject and then 2 subjects and I can pass and fail in the others. Most of us don't come thinking of that. We want 90% in all our marks, right? We've grown up like that. So we hate it when our stocks behave like that. But in truly behaviorally, that is what needs to change mentally. One switch has to be flipped. Saying gaya to gaya. It is not a reflection of how stupid we are. We are stupid. We should have admitted that right in the beginning. But the point is that the fact that 8 of your stocks don't give you great returns and only 2 do is normal. It is not reflective of how stupid you were in selecting them. It's perfectly fine. So, yes. So, sorry about this. I think I've stretched a little bit. But I think Vikrant talked about liquidity of RBI bonds. And let me quickly go there. There are RBI bonds cannot be bought in secondary market. No, I think RBI, specifically those RBI 7% bonds, they're locked in and they can't be traded. You can buy Government of India bonds, there's some issues with that. Government of India bonds have they come under this thing called SGL, Securities General Ledger. If you saw the scam series, you would have seen the situation over there. We can have a separate discussion on the scam thing, by the way. But there's something called a Securities General Ledger, which is at the RBI, which is the demat account of banks, effectively, when they buy government securities. So that Securities General Ledger is held by the RBI, not by the NSDL and CDSL. So they created a bridge between that and NSDL, CDSL, so that you could buy your RBI bonds, that's Government of India bonds, different from RBI bonds. The RBI bonds are these locked-in things. We'll keep that separately. The Government of India bonds, or GSECs, government securities, you could buy those and trade them. However, we do have a problem there, because if you buy on the exchange, you don't know whether the other guy on the other side is an NSDL or CDSL holder. Now, to transfer between NSDL and CDSL apparently takes 15 days or 20 days, because they have to go to RBI, and apparently RBI gets only its demat holding changes by carrier pigeon, because they take 15 days to allow a transfer between one depository to the other. For some strange reason, this has happened in the past. If the other guy is on the same depository, then intra-depository is fine. You don't know that when you buy, because you don't know who the other side is. Sometimes you can get the security within 2 days. Sometimes you'll get the security in 15 days. You can't control that. But tradability wise, sometimes because you don't have the security, you can't sell it. So you can't trade it that often, but it does have problems, and because of this, liquidity issues arise. If I can't trade a security, then I'm only dealing with people who are buying and holding for the long term, right? So when do I get the sellers? How do I generate I don't have the arbitrageurs, the people who can buy and sell on one exchange into the other immediately, because they can't deliver, because they don't have any deliverability on the other side. That because of that, you won't have volume, and therefore liquidity is low. So hopefully they will change this. They've already changed this for the banks in the NDS OM framework, but not where we are. Floating rate RBI bonds, again, they are good, but they're locked in. They're for the long term. So you're literally saying, with that money, I don't want to participate in equity or any risk. So that's the good thing. But there is a risk of interest rates falling further there, because interest rates, if they fall further, NSE rates fall further, RBI bond returns will come down. But other than that, there's not much risk over there, and especially for people who want less of that risk and don't mind locking in, that's the thing that you have to do. If you want to really minimize risk and get better than FD rates, the one thing is to go longer duration with RBI and say, I don't mind locking in. If you want liquidity also, then you could buy a combination of the bonds that I just demonstrated in the beginning, and something like short-term gilt mutual funds, where you'll get very little, 3.5%, 4%. So you could do a combination that gives you slightly better. Or you could just go to an IDFC First Bank savings account. They give you 7%, up to 10 crores. So create an account, put your money there, short-term is fine, and they will change these interest rates sometime. And when they change it, we'll see what the next instrument is at that time. So that's one way to do it. A very large lump sum amount, again, it depends on where you are. I won't, it'll depend on specific people of how risk taking you want to take it. But like I said, RBI bonds are a good alternative at 7.1 currently. What was my first multi-bagger? Okay, I'll kind of end with this perhaps, but there are two companies which actually made me a lot of money in 2002 or 2003, 4, that kind of time frame. This was a company called Syntex, which gave me a 4x return in 3 months. In 2004, I think, I don't remember that. And a company called Opto Circuits, which doubled in 2 months. They were my first multi-baggers. They're both next to zero now, which tells you why buy and hold may not necessarily be the strategy that to go from. Third company that made me a lot of money, and I didn't hold it, I sold it at the same time, was Reliance. I sold it because the brothers started fighting. And I said, okay, I can't deal with this shit. I should have held. But if I had held it, I would have made a reasonable amount of money. But that was my personal set of multi-baggers. And the big bet that nosedived, I don't know. I mean, I've done a lot. I mean, the biggest bet that nosedived was me listening to a lady in 2008, October first week. When the Nifty was down 33%, she told me, "Aren't you patriotic? Don't you think your country will do well?" I was short all this time. She knew because she was the compliance officer of this company we were trading with. And she's like, "You guys are short. Itna pessimistic country mein koi belief nahi hai kya?" I went home, I thought about it. I said, nahi, kuch to karna chahiye. I shifted the entire position to long, leveraged long. I wrote puts and I bought futures. The Nifty went to 2,800. I lost a lot of money. So don't be patriotic. So, that is, as in, don't be patriotic in the sense that buying stocks for patriotism is dump. You're patriotic as it is. You've got your life invested in a country. And you're very positive on the world, but doesn't mean that you go leverage yourself for a short term and try and make money out of it. If I'd held that short position till now, I would have made a lot of money. But who has that much money also? You lose it. Like Harshad Mehta could have, नारके दमानी said, अगर हर्षद अपनी positions एक हफ्ते और रख लेता, मैं रोड पे उतर आता. It is true. Harshad lost because of liquidity. Of course, he created that liquidity and he went up because of that liquidity, which was false. So when that liquidity broke, everything broke. That's fine. But you shouldn't do that to yourself. No, I learned that. I knew the Russian Mother story also, by the way. And I leveraged myself and I lost a lot of money. I never went bankrupt because I didn't have so much to lose. But that was a lesson that I learned. I hope this has been helpful to you guys. I don't know. Maybe I should stop here. I have a lot of questions. I can always take them more on Slack. But like I said, how to make wealth is a very interesting question. One of the biggest problems with giving a single answer to that is what happened with the phone call. I mean, when we started off with the bonds, you see, I showed you a quote of a bond that was at 9%. I went and showed you how it was calculated. By the time I shifted back to Kite, somebody had taken that off. If there is a way to make wealth that everybody can use, you can guarantee that somebody will use it. Instead of me telling you how to do it, it's got to be a slow, laborious process, which is the best way to make wealth. Because there are always going to be shortcuts, and you can take those shortcuts whenever you feel like and make it. Because once you've made the grade, then you're honest, right? R.K. Damani could have been whatever he was in the past. Once he passed that 500 crore or 1,000 crore mark or something like that, suddenly now he's white shirt, clean guy. Forget his past. So once you've made what you have made, you're clean. So whatever mechanisms you adopt, you just fit your conscience. That's all. Nobody else can judge you for that. Because like I said, once you become clean, then people will think of you as clean, no matter who you are. The thing about it is you have to choose what level of conscience you're going to use in order to make that wealth. And if it means that you got to struggle a little bit longer for that to happen, then that's what you got to do. But it'll help you because you'll sleep better at night. You can use stocks to make wealth. That's not a problem. You can also use your business, your job, your career to make wealth. And that's also not a problem. And both ways you can achieve this number that you want to achieve. If it's a reasonable, I think beyond 20 crores, most of us will not need money. So just the point is to get to that 20 crores, what do you do? And the answer to that could be run your own business, could be invest in stocks for the long term, over time, and hope that portfolio builds up. Or it could simply be, convince a couple of VCs to invest in your business and convince a couple of other companies to buy that business from you at a 20 crore profit for you 5 years down the line. It's all the same. The idea is just about what you can do and what you're comfortable doing. So sorry about the philosophy. I will stop here. Last question on interest rate cycle with Mehul side. I think we should be careful about inflation here. Inflation continues to be sticky and high. on the food side. If that continues, we might see at least a pause. But I think the economy has been damaged so much that I don't think they will raise rates for the next 1.5 years. So I think till 2022 we are reasonably safe in terms of not interest rates not going up too much. Maybe the way to make wealth is the next 15 months in the by using these low interest rate mechanisms, and then to buy fixed deposits when the interest rates start going up. So I'll leave it at that. It's been 1:30. I'll break. We can break for lunch. We can come back. There are lots of more questions, but I'll stop here. Thanks very much for all the participation, and we will kind of end this at this point. Thanks a ton for all your for watching, and let's meet more, have more discussions on Slack. Cheers.